How much is a company actually worth? Sounds simple enough, right? But you look at the stock market on any random Tuesday and prices are just swinging wildly based on rumors, news, or just pure market sentiment. So the real question is, how do we cut through all that noise to find the true, fundamental value of a business? Welcome to today's Explainer. I am super excited to get into this with you because we're unpacking the absolute ultimate truth teller in finance, the discounted cash flow analysis, or DCF. This is literally the exact tool mastered by hedge funds, investment banks, and private equity folks all over the world. And by the end of our time together, you're going to understand exactly how it makes them tick. Here's our roadmap for today. We've got 5 quick sections. The core idea, decoding the cash flows, discount rates and risk, the Asian paints valuation, and finally, pitfalls and limitations. Let's jump right in. All right, section 1, the core idea, the anchor of value. So what exactly is a DCF? The whole philosophy here is actually profoundly simple. A company is only worth the present value of the cash it's going to produce in the future. That's literally it. You just project the future cash flows for, let's say, the next 10 years, and then you discount them back to today's dollars to figure out what that pile of cash is worth right now. And you know, the history here is fascinating. This isn't some new Wall Street fad. While it was formally put into modern economic terms by John Barr Williams back in 1938, and it definitely caught fire after the 1929 market crash, the concept has actually been kicking around since 1801 in the UK coal industry. It's a rigorous, totally time-tested way to zero in on fundamental value and just block out the market noise.
Moving on to Section 2, decoding the cash flows. What comes in?
Okay, so this is where we hit our first major crossroads in building a valuation. On one hand, we've got FCFF, free cash flow to firm. This is the pool of cash available to literally everyone, both the debt holders and the equity holders. You calculate it by taking your operating income, stripping out taxes, adding back depreciation, and subtracting any capital expenditures and working capital changes. And since it's for everyone, you discount it using the weighted average cost of capital, or WACE. Now, on the flip side, we have FCFE, free cash flow to equity. This is just the cash left over strictly for the shareholders after all the debt obligations are handled. You discount this one using the cost of equity. Valuation guru Damodaran actually recommends using FCFF for high-debt companies because it keeps things cleaner. But he also notes that FCFE is a lot simpler if you're just starting out, simply because it hands you the equity value directly.
All right, Section 3, discount rates and risk. What is it costing us? Well, it all starts with a baseline, which we call the risk-free rate. Now, for an investment to be truly risk-free, it has to have 2 things: 0 default risk and 0 reinvestment risk. If you're valuing a company in US dollars, you might just look at a 10-year US Treasury bond. Simple enough, right? But there's a catch. This assumes absolute certainty. And let's be real, absolute certainty is incredibly rare in the global market. I mean, what do you do if the country you're operating in isn't exactly risk-free?
So, how do analysts handle emerging markets? Say you're valuing a company in Brazil. You can't just use the local bond rate because the Brazilian government inherently carries some default risk. One clever workaround is to compare a Brazilian US dollar-denominated bond directly to that US Treasury bond. If the Brazilian dollar bond is yielding 7.75%, while the US rate is sitting at 4.58%, that 3.17% difference, that's your default spread. It is the exact premium investors are demanding to take on that specific country's risk.
But wait, what if a country doesn't even issue dollar-denominated bonds? In that case, analysts lean on sovereign ratings from agencies like Moody's or S&P to find typical default spreads. The big takeaway here is that not all governments are risk-free. If you want to build a truly accurate DCF, you have to meticulously quantify that geographical risk and bake it right into your discount rate.
Let's put this into practice with Section 4, the Asian paints valuation, building the model.
Okay, here's our starting line. Let's look at the rounded baseline financials for Asian paints in fiscal year 24. We've got revenues sitting around 35,000 crore rupees, an operating profit, or EBIT, of 6,000 crore, a tax rate of 25%, with capex at 600 crore and depreciation at 500 crore. We absolutely need this anchor before we can even think about projecting into the future.
So let's walk through the mechanics of a classic 2-stage growth model. In Stage 1, we project out a high growth phase. For years 1 through 5, let's assume a 12% revenue growth, which then gradually cools down to 7% by year 10. We use those rates to calculate our free cash flow to firm for every single one of those years. But obviously, we can't calculate year by year until the end of time. That's where stage 2 comes in. For year 11 and beyond, we calculate something called the terminal value. This assumes the company just settles into a nice, stable, long-term GDP growth rate of about 6%. Finally, we take all of those future years and discount them back to present value.
And this right here is the massive aha moment in valuation. For most companies, that terminal value, the assumption of stable growth from year 11 into infinity, it makes up 60 to 80% of the entire valuation. Think about that. In our Asian paints example, the present value of the first 10 years of cash flows is roughly 50,000 crore. But the present value of the terminal value is sitting at about 66,000 crore. That means your single assumption about long-term growth is hypercritical to the whole shebang. So, the grand reveal. When we add all of this together, subtract out the debt, and divide by the number of shares, our baseline DCF model spits out an intrinsic value of 1,217 rupees per share. But the current market price is hovering way up around 2,800 to 3,000 rupees. So what does that actually mean? Well, it suggests that, based purely on conservative future cash flows, the stock might be pretty expensive right now. Or, alternatively, the market is just pricing in way higher growth than our model predicted.
Which brings us perfectly to Section 5, Pitfalls and Limitations, the Reality Check. Listen, at the end of the day, the DCF is just a mechanical tool, and that means it suffers big time from the garbage in, garbage out problem. Analysts make these critical mistakes all the time. Like, they'll plug in this wildly optimistic 20% growth rate for an entire decade, which, frankly, is nearly impossible for most mature businesses. Or they'll set a terminal growth rate that's actually higher than the overall economy's GDP growth. Mathematically, that implies the company will eventually swallow the entire global economy. But the absolute biggest mistake? Relying on a single spreadsheet output without running any best-case or worst-case scenarios. Just tiny little tweaks to these inputs will create massive, sweeping swings in your final valuation. On top of that, traditional DCF models really struggle with something called the problem of induction. It's basically this philosophical trap of assuming that the future is going to look exactly like the past. And as we all know, past returns definitely do not guarantee future results. This is exactly why a DCF is fantastic for mature, rock-solid companies like a utility provider or consumer goods, but it really falls apart in unpredictable environments. Try valuing an early-stage tech startup that has zero historical cash flows, or a commercial real estate project trapped in wild boom-and-bust rent cycles. In those scenarios, a traditional DCF can lead you to some massive overvaluations. It's also worth pointing out that the valuation landscape is rapidly evolving. Traditional models only really care about financial costs and benefits. They completely ignore natural and social capital. That's exactly why we're starting to see the rise of integrated future value, or INT-FV. This fresh approach actually expands the DCF to include environmental, social, and governance factors. So, for example, it might attempt to price the social cost of carbon directly into the model, accounting for the actual damage to society from greenhouse gas emissions. It's a really fascinating step toward getting a much more holistic view of true value creation.
So I want to leave you with a bit of a provocative thought today. If a tiny 1% tweak in a growth rate or a small shift in a discount rate can magically change a company's calculated value by literally billions of dollars, are you really measuring intrinsic value, or are you just using math to project your own optimism onto a spreadsheet? Discounted cash flow is undeniably the most rigorous tool we have in the toolbox, but as you can see, valuation is just as much an art as it is a science. Thanks for hanging out with me for this explainer. Keep questioning the numbers, and I'll see you next time.